Okay, so
If you ask us to then give like the income statement and balance sheet
you bet.
on.
Might on a quiz or a test or a final have you actually, I don't know,
I don't think we should do it on
having
Friday.
not written it yet, I don't have a clue.
Yeah, for just
That way I don't,
Just
you know,
use your
inadvertently, what I do is something I cover really, really well and extensively, I make sure not to put that on. Well, you know, and that wouldn't be a challenge for you, we just did it, yeah. It's about being fair, it's about you learning a lot, yeah.
On the last quiz, we did, like, almost all of it was like the practice quiz, but then the back page.
Oh, really?
I missed every one on the back.
Why did you do that?
One of them was given to you.
Where did that come from? Like, I was just wondering, so maybe I can be prepared for the back page on this one.
You kind of have a point.
You're not supposed to memorize how to do a quiz, you're supposed to learn the material.
Yeah, I
If you can see a problem that looks unfamiliar, you just relax and you read it and figure out what's going on.
So, I mean, if I would've, honestly, I ran out of time, but.
Yeah, well, you know, if you see things that are familiar, you do them really quickly.
But so that one was possible with all the knowledge we had from the.
Absolutely. Sure, somebody got 30 points, but is it possible?
Maybe that's really smart.
Yeah, probably. They probably work really hard, but they're ugly, right? Yeah, makes it all okay. I hope your ears said that.
Wasn't it 45 points?
29.5. No.
45 questions.
Doesn't make it 45 points. Man. Okay. This is a good review so far. Explain how grading works. Okay, anyway. Let's talk a little bit. Just relax when you see a problem that doesn't look familiar. That's the danger of giving you guys those practice or whatever they are, those old quizzes. Because if I do give you something similar, oh yeah, I know what I'm doing, well maybe then you feel comfortable about that, you should be able to do it anyway. Right? So I try to mix it up a little bit. So you will see some that looks like things you've seen before, either homework problems in the book, exactly like them, and you'll see some that look exactly like maybe problems from the quizzes, right, that I gave you, and then you'll see some you've never seen before, and start getting used to that. If you move on into 211, right, the intermediate accounting class, if you're an accounting major or a finance major, none of them are going to look like the book, and none of them are going to look like homework problems, and none of them are going to look like old quizzes or quizzes anyway. So, you know.
Why don't we have like accounting for dummies? For people that like.
There's a book you can buy.
But for like people that don't actually like need this class for their accounting.
But see, you don't know because you make sure you do a CPA before we're done.
I do know
it happens all the time. So you know what's really funny is a lot of people who come in and are going to be accounting majors or finance majors meet me and change their mind. I don't know what it is. Yeah, but, so they start feeling, I like this, I'm not good at this, I'm not willing to work hard enough at this, whatever. So I'm not doing it. And so a lot of people change their major to something else, that's cool. And then an awful lot of people, I use as many as I get, pretty much. And I'll have people come from all kinds of places. I had a communication major last semester.
That would be
They come and they decide, this is really challenging. So now double major in communications and accounting. It's got to have 150 hours anyway. And think of it. It's public accounting jobs. Communications? No kidding. You just bullshit with people for a living. I think you're talking about it. It's a perfect communications job. Right? And then, if you know accounting too, it's a high-paying communications job. Oh. No, I'm not really. Not really. I don't do that on campaign here, and I don't like it very well. Right? So it'll make a lot of couldn't make money when I'm retired. I'm old, frankly.
But if you know how to do it.
I don't have long pants anymore. Yeah, for all kinds of reasons. I'm going to switch to jeans soon when it gets cold. If you guys pay me, I'll wear a suit. They're annoying. Still copy them, you have to throw them away. That's a lot of money. Jeans you still copy them, so right? Why don't we just wear jeans all the time? She could care less what I do. Yeah, she could care less. Actually, I don't buy any of my own clothes. So if you like anything I wear, you should call it. Congratulations. Yeah. I'm like a little kid. I kind of dress like a little kid, too, actually. She buys whatever I wear. But see, she has grandchildren now, so she probably buys these clothes the same way she gets there. So, yeah. Let's do some work, you guys. Okay, anyway. Yeah, I was recording all that. That's good. 5 minutes and nothing. This is that furniture refinishing problem we were doing. Do I care if you do the income statement or the balance sheet first? Not in the least. It doesn't make any difference. What I do is I typically start with the balance sheet, because if you look at the accounts, you know, that we had in all those key accounts, all we're doing is we're copying the number, the ending balance in the account, right? So you figure out what your ending balance is, and you copy it on these statements. I'd start with the balance sheet just because the accounts that are listed first, whoops, there it is. The accounts that are listed first are the assets, right? So here it is. I'd start with the balance sheet. The thing is, you can't do retained earnings until after you do the income statement. But so what? I can figure out what retained earnings must be when I'm doing the balance sheet. So here's what I've got. I put the company name. You know, we always write that really nicely. By the way, if you have Alan Beck later, if you're an accounting or finance major, ask him what he wants you to do. Same with Richard Schrader. With me, you can abbreviate everything. Just make sure I know that you meant furniture refinishers, so you can abbreviate the words a little bit to be faster. That's all. Okay, in real life, of course, you write it out perfect. Okay, you know, you're going to give the financial statement to somebody. And then balance sheet, and it says at, but I mentioned in class, real fast at the end, that you don't need to put as ever at. You just put the date. Okay? Notice it does not say for a year ended. That's because we don't close these accounts. They're permanent. It's really from the beginning of the business through now, isn't it? Okay. All right, anyway, so we list the assets first. Current ones first. What does that mean? Current is, it's going to last for a year or less. Got it. What's non-current mean? More than that. What's a current liability? Going to be paid within a year. What's non-current? More than a year. Big deal. Okay, so we list all the current assets, and you're also supposed to list them in the order of liquidity from the most liquid to the least. Cash is closest to cash. You can spend it right now. Accounts receivable are going to be collected fairly soon. That's the idea. Merchandise inventory, if you had it, would be next. Okay, so on. All right, anyway, so they listed the current assets, and they're assuming small tools is a current asset. I'd be fine on this problem if you said maybe it's not, you know, maybe it's going to last for more than a year. I don't care. And then equipment is a non-current asset. See how? Remember I said you take away the accumulated depreciation? There it is, right there. Everybody see it? And then we get the net book value, and then the other assets they assume were non-current. And seeing as they put it later in the chart of accounts, in the list of accounts, it probably is non-current. You usually tell by the order of your accounts what they are. By the way, you want me to do too? Always you put the first number in the account, no matter how long it is a 1, it's an asset. It's a 2, it's a liability. Usually a 3 for equities, a 4 for revenues, 5, 6, 7, 8, and 9 are different types of expenses. So when you look at the first number in the account, even if it's 10 digits long, you know, if it's a really big company, the first number tells you what kind of account it is. Kind of nice, huh? So you want to accidentally use the wrong number. And then they just assign numbers to the accounts, and you don't really use the names, you use the numbers when you're doing the accounting. So it's just easier. So anyway, so we get total assets of 74, and what you want to make sure of is your liabilities and stockholders' equity also total 74, right? You already know the answer on that side. So what we do, I'd write the 74 down there. Well, when I'm done, I guess. List your current liabilities, and they're all current, aren't they? For a total of 44. Could there be non-current? Sure, you could have long-term debt, couldn't you? Mortgage, bonds, different types of things. So you could have non-current too. These are all current, so we get the 44. And then stockholders' equity is common stock, additional paid-in capital. And you know what? If I knew the total liabilities and equity are 74, and I know the liabilities in total are 44, don't I know the equity is 30? Got to be. You can put the 30 in there. You could have the 7 common stock and the 13 additional paid-in capital, which would be 20. And in real life, we'd say total contributed capital too, by the way. I don't care on this one, just to give you the idea. Couldn't you just plug in the retained earnings? It's got to be 10. Yeah. And then just make sure when you do your income statement, it ties to that, right? Or your equity statement, it ties to that. Okay? So then what you could do after that is do the income statement, or you can do the income statement first, I don't care. Notice on this, company name, income statement, for a period ended, right guys? For a period ended. Why does it say that? It's for a year or a quarter or a month. Because that's what it is, right? You close the books, start at 0, and add it up. The revenues and expenses for the year, don't you? Okay, everybody good? Right? So that's why we say for the year ended. It makes sense. On the balance sheet's the only one where you don't say for the year ended. Why is that? You don't close those accounts. You don't have to memorize it. It's common sense, isn't it? Once you understand. Okay. And so we got income statement for the year ended, and then we'll list all our revenues. They only have one, but big company, of course. You might have a lot more, more complex company. They list all their different expenses, look at almost all remaining expenses, but anyway, you can imagine there'd be a lot of expenses listed. So your expenses away from your revenue, they say is operating income, that's fine. And then they have interest expense separate. If you put the interest expense up with the other expenses, I'd be fine with that for now, okay? And yeah, then we get pre-tax income. That's the revenues less the expenses other than tax. Take away your income tax expense, and there you are, net income. I'm not going to worry too much about earnings per share yet, but all it is the number of shares outstanding, the number of shares that are out there, divided into the net income. It's how much each shareholder earns per share. Big deal. Okay? How'd they get the 70,000 shares? The company started out with what? 50,000 issued, right? 50,000 said were issued, and they're also outstanding, by the way. We got that later. Okay, but there were 50,000 issued, and we issued 10 more this year, didn't we? Remember that journal we made? So that's where they got the, or we issued 20,000 more, sorry, 20,000 at 50 cents each. Yeah, so 20,000 plus the 50 was the 70. That's where they got that. So no big deal. Now what's going to happen is you need to take this 16 now and add it to retained earnings in order to make your balance sheet balance, right guys? So you take a look down here. Here's the company name, statement of stockholders' equity, also for the year ended because we start with the beginning balances. These are just out of the accounts. There's common stock, there's additional paid-in capital, there's retained earnings, total equity, you like it? Additional stock issuance was 1,000 here and 4 here. That's that journal entry we just made. So you get the ending balance of 7 and 13 that we had in the T account, right guys? In the general ledger. But notice what happens here. You take out the dividend that we recorded to retained earnings. And remember we had retained earnings. It was 4 to begin with and then credit. And then we did a debit for 10 for the dividend. Yeah, I'll write it for you. It's like this. Retained earnings, beginning, right, was how much? 4? The dividend we recorded was 10, huh? And we said there's 6 in there, debit. But you know what? What I want to know is the ending. For my equity statement, right, and my balance sheet. So the net income needs to come in here. And what did you just say the net income was from the income statement? 16. So what's the ending? 20 less 10 is? Okay, ta-da. That's all we're doing. Everybody got it? But you've got to pick up that net income or your balance sheet won't balance, of course, because we made entries, debit, cash, credit, sales. Cash went to the balance sheet, and sales went to the income statement. It's got to get added to retained earnings. We debited accounts receivable and credit sales too, didn't we? You got the idea? Okay? You might debit unearned revenue and credit sales for service revenue, right? We did that too, didn't we? Maybe. Okay? Got the idea? We've done it in other files. So you got to pick up that income. Also on the expense side, don't we debit expenses and credit cash a lot? Debit salary expense, credit cash. Don't we debit interest expense, credit interest payable? Yeah, you got to pick up the expenses too. Where are they at? On the income statement. Make sense? Because you're changing the balance, you're changing the assets and liabilities on the balance sheet, so you better pick up the changes in retained earnings. And we aren't going to put it in the retained earnings account until we do what? We're not going to put the net income in the retained earnings account until we do what? Close the books, right guys? Until we close the books. We can't, because if we do, we can't do an income statement, because what's going to be the balance in all the revenue and expense accounts after you close the books? 0. Well, then what would your income statement look like? Not all that high, right? So we have to do it this way. Okay, it's fine. Everybody good so far? So where does that stockholders, or I'm sorry, where do these numbers 7, 13, and 10 go? Right over on the balance sheet. In fact, what you could do, probably would do, is you'd have, well, I guess you'd show common stock and additional paid-in capital still, and then you total those, and then show retained earnings. So it's all right, we can do that. Everybody got it? These 3 right here, that's just off the equity statement, isn't it? Is the net income included in retained earnings there at the end? Yes. Everybody see it? That's a real common mistake. People panic. Oh, my balance sheet doesn't balance. Well, yeah, you didn't add the net income to it. What if it's a net loss? Take it out, right? Net deficit. Okay? All right, let's look at the closing entry that goes with this. That's the only other thing, wasn't it?
Can you point out where, I'm sorry,
No.
the net income really is, the 16,000?
Oh, it's on the income statement,
Okay.
right here.
You can see it on the balance sheet, I just wasn't.
Oh, it has to be in the balance sheet. The way it gets there, I apologize. 16 net income here, right, on the income statement. Then when you go to the equity statement, the 16 gets added to retained earnings on the equity statement. Because when we do close the books, we're going to add it. You with me? Okay, so I put it in there. Now it's included in the 10 retained earnings. And when you go to the balance sheet, that 10 retained earnings includes the 16 income. That's the way I should have said it. Is that going? You're probably not the only one. Okay? Everybody good? Come on. Okay, let's look at a closing entry. This is unbelievably easy. You got to really hope that I give you one of these. Look at that. All the revenue accounts have a credit balance in them. There's only one here, but you could have more. How do you make it zero? Debit it for the amount that's in the account, and now it's zero. I'm not kidding. That's what they did. All those expense accounts, what kind of balances did they have? Debits. How do you make them zero? Credit them for exactly their balance. Now what will they be? Zero. What day do you do that on, by the way? The very last thing after doing your financial statements. You can either date it December 31st or January 1st of the next year. It doesn't matter. It's kind of in between the years. Think about it that way. Once your statements are done, your financial statements are done, you do this so you can start a new year. That's it. Big deal. So, oh, by the way, where does the net, what was the net income? 16, and how much got added to retained earnings there with the credit? 16, it's a miracle. Isn't it? So now, retained earnings does have what balance after closing. It has the balance credit of 10 right there. It does, doesn't it? Now it's got the correct balance. But what's the balance in all the revenue and expense accounts? Zero now to start the year. So then they had you do a trial balance. And by the way, I don't know anybody who does this. Didn't they have you do one? Maybe I'm lying. Maybe they didn't. Good, they didn't. A lot of times they do a post-closing trial balance. They did not. Good. What is a post-closing trial balance? You list all the assets, you list all the liabilities and equity to make sure the totals agree with each other. Well, you know they do. You're in balance to do your financial statements, right? And then you do a closing entry, which is in balance. So, of course, you're ready to go for the next year. And now, that trial balance is going to look just like what we started with, only with the new year added to it, right? All the changes. Did everybody see the whole process then? And then we start over. That's called the accounting cycle. In high school, we would have spent a semester getting this done. Anybody do accounting in high school? I'm not kidding, no. It just takes forever. It drives you crazy. You know what I'm saying? How long does it take you guys to figure out how this model works? I don't know, a couple of weeks. Are you quite there yet? Maybe not. Perfect. Get perfect by now, okay? But by the final, you'll have this wire, really wire. And we're going to start layering complex business transactions into this. Now that we got the model, we'll just, what about this transaction? What about this transaction? What about this transaction? What would we do? What would we do? How would we account for that? Okay? And we just use the same model over and over and over. All right? Every company in the world does this. Okay? Everybody closes their books. When somebody says closes their books, what are you going to say? We're going to close their books. What are you going to say? Okay, with me, I don't care. Start the new year. But you know what it means now, right? So that's kind of good, don't you think? Or what if they say, will you please close the book? Kind of, God, I'm going to call Keith. Yeah. Let me get my principal's book out and I'll do it for you. Yeah, okay. Sure, I'll do that job. Okay. All right, guys. Okay, let's do some problems. Do you want to do the quiz, or is there something else burning? Do the quiz. All right. Have you been trying it? Yes, no, maybe.
Will the quiz Friday be multiple choice or short answer?
I don't know. I haven't done it.
Are you writing?
Maybe essays. No, probably not in this one. Probably number crunching, problems, journal entries, multiple choice, fill-in stuff, maybe, terminology.
Just journal entries.
You ever have journal entries in multiple choice?
Yeah.
Yeah, I don't like multiple choice either. They drive me nuts. Yeah. Will there be material from chapter 5? Not on purpose. Are you suggesting on the first quiz there was material from chapter 3 and 4? Yeah, probably. But it wasn't on purpose. Yeah. No, not on purpose. I'm driving you crazy, huh? Yeah. If you've already read chapter 5, that's kind of nice. Have you? I wouldn't read chapter 5. It's more theory type stuff. I wouldn't read chapter 5 for this one. I just do 1 through 4 for this one. So, yeah, you don't worry about that. Okay. From here on out, reading a chapter before you do the quiz is probably not a great idea. But that brings up a good point. The day we do the quiz, we'll be done with the quiz. So then what you do is you take a week's vacation, right?
Yes.
No. There's a test 2 days. Yeah, I know. A lot of people do. I would do this. There's a test a couple days later, right? Half a week later. And then when you take the test, what do?
Take a month vacation.
Read that next chapter because it's going to be hard, right? It's going to go crazy.
I'm on vacation with her.
You're on vacation with her?
Yeah.
That's Christmas. You just wait for Christmas. Keep thinking about Santa. You'll be fine. Okay.
So inspiring.
Yeah. I've done a lot of that. I'm waiting. I got to tell you guys this. When I went to college, I don't know if I really want to do it. I don't know if I really want to do it. So I went to college. I signed up for classes the last day you could. That's what my schedule looked like. And I didn't know what I was going to do. I just took some. And I heard that I was going to go to law school, and I heard if you did business, you could get to law school pretty good. And business wasn't too hard. You didn't have to do very much math. Is that familiar, you guys? Yeah, anyway, I started into college. This is ridiculous schedule, early in the morning, late at night. And by the middle of the semester, I was sure I wasn't coming back. Screw this, I'm not doing any of this anymore. I've had enough of this, so I'm going to go do something else. Put my thumb out and wander around, right? Protect. And so, anyway, so then I get done with the semester, and I still think I'm not going to go back. So I kept myself going long enough to get decent grades, right? Not good, but decent. And then, a few days before school started, I'll do another semester. I did that all the way through college, including my PhD. In my PhD program, I was sure the first day of our quarter system at Oregon, I was sure in the middle of the first quarter, this is ridiculous. I'm done. I never do Oregon again. That's why we're Oregon.
Is that why you like to
Anyway, yeah, well, I grew up in Oregon too. I really liked it. You know what? They were the worst team in the Pac-12, Pac-10 in those days. They were the dregs of the league. There's hope for Kentucky football. See? Yeah, anyway. Yeah. But I did it all the way through. If that's your strategy, it's great. It made me feel better. So I'm not kidding when I say, Christmas. Keep yourself working. You get Christmas. And then you can sign up for the next, don't wait, sign up this semester for next semester, please. Right? Don't do what I did about it. I had some ridiculous classes. But anyway, get signed up for next semester, but don't think about it, right? Except you want to read 2 or 3 chapters in each one of your books, right? Before the semester starts. Just accounting. No, you want to do it in all of them. It'll work good. Okay, let's do this. All right, you want to do the first problem?
Yeah.
Yeah, okay. Now, what's different about this one than the other quiz? It looks just like it. What's different about it? No. What's different about it? Somebody tell me. There are what?
2 companies.
There's more accounts.
There were 2 companies in the other one, too. There aren't more.
There's 2 companies, but there wasn't.
There was not a beginning balance before. It was their first year of operations. It was 0. It's the only difference. It's exactly the same problem with beginning balances. Big deal. Right?
Yeah.
So how would I approach this thing? What do you want to do? Ernst & Young Company, the CPA firm Ernst & Young, isn't that clever? Okay, anyway, what do you want to do here? Oh, and I put these out of order too, didn't I? They're in ridiculous order. I don't think there are more accounts though. I think it's the same stuff.
Yeah.
Would you make 2 charts?
Well, you could, except this is the financial statement as a whole, so what might you use?
I was going to say just start from assets, liabilities, stockholders' equity.
Oh, maybe like this? She says do this.
Yeah. Make that.
Do you guys like that?
I love that.
Yeah. Isn't it nice when you can use things you know to solve problems that look new to you? Oh man, that's cool. When you go out there and you're working and you don't have a clue what you're doing, but you can look at something and say, you know, this looks similar to another situation. I wonder if it's the same, and then you start trying something and it works. Oh God, it feels good. Wow, this worked great. I don't have to learn something new. I already know it. Cool, huh? So you don't have to learn anything new here. What do we want to do? We want to write down everything we know and solve for what we don't know. Oh, by the way, equity consists of two things, which are contributed capital and retained earnings. Excellent. Okay, good deal. All right, guys. Guys, are you women offended by me saying guys all the time? Good, because I just can't break the habit. Our chair who just left to go to Colorado State, she told me I had to get over saying guys because it was sexist. I know, but geez, there are big things. Yeah, okay, what if I said, okay, girls, now you'd be offended, so it is sexist, see, it is, right? But I don't mean to be, yeah, and honest, I'm just old, so. That's like when I slip up and I call one of you young women sweetheart every once in a while, which I do. My wife said, you can't call your student sweetheart. I'm 63 years old. They look like my granddaughters. What am I going to say? You know, so close to the same age now. They're closer to your age by far than you are to mine. Right? They're 4. They're closer to your age than you are to mine. Think about that. That's sad, isn't it? I am really old. Okay. Anyway, so okay, what do we want to do? Let's write down all the information we have for each company to solve what we don't have. Go ahead and do it. You guys just go ahead and do it, and then let's do it first. Yeah, you do it first, and then we'll work. Oh, let's do Ernst first.
We do
Go ahead and do it.
the starting balance or the other one?
I think I'd use both. I think I'd put the starting balance as the beginning balance, and then I'd put the ending balance as the ending balance. And what you could do, you like that? And what we could do is we could put the beginning maybe here, and the ending here, and put them all the way across, or you can put them both on top or both on the bottom, I don't care, right? But put everything you know about assets, liabilities, equity, revenue.
Two statements, two claims? No?
I wouldn't. That'll be scary.
I was joking.
Yeah, good. It's all right. There are no stupid questions.
Right.
So that clearly wasn't one. Okay, good. Don't do two. You don't want to do one of those. That'd be really confusing. Just write down what you know, and then start solving for what you don't know. But all the way, take everything you know and write it down in that. Take those numbers and write them down. Oh, good. She's doing it. She's doing it. Yeah. You know where they go if they're a beginning balance? Read carefully. Which years begin and which years begin. So 2012 first, and then 2011 second. Be careful. 11's the beginning, 12's the ending. Watch that. They switch them in. They don't switch them in financial statements, but we do in problems for some reason all the time. And on worksheets when you're at work, they might be too. You know, the old year first and the new year. What do we do in financial statements? The newest year and then the oldest year. The newest year comes first. So you have to read carefully. That could really mess things up. People here, that's pretty good. Pretty good. 40%. You about 50 people. Yeah, nobody comes something like that. That's pretty good. I find that people who come for review sessions get better grades. It has nothing to do with review sessions, just they're more motivated. I don't know.
Wait, do we only need numbers where there's a little letter?
Yeah, you're going to solve for all of that.
So, but I don't need to worry about it.
Oh, no. You're writing this. And then you're solving these.
Yeah, I know.
You don't know those other, there aren't going to be no numbers there. You write right in the minutes. Sorry,
Is it gone?
Yep.
Yeah, I think you're right.
Well, maybe you already worked on it. Why did you have this one? Spend so long here. Oh, that's what I'm doing now. Oh, you might be right. Break that. You don't really spend so much.
Yeah, I do, because I have liabilities and assets, so it still has to be done.
Yeah. That's because she was so wrong. Yeah, no, equity.
Hey.
See, this is how I get communication majors to do this. I have a really hard time. You can get maybe.
I can read this.
Well, accounting's business.
That's why it's business.
Accounting's a type of business is profit. Finance is also. You might fall in love with this stuff, you never know. So everybody have answers? No, this is quick. How many points is this? 5 points.
Oh.
How long should it take you?
I think we start with.
Yeah, maybe 10, right? 10 minutes maybe. Maybe. 5 for each company, right? 5 for each company, or 4 minutes for each company, maybe. Keep it set up. Making progress. Look at what kind of solve, what's in this. Everyone, once you solve that one, you solve that one. You can't work together. Yeah, okay, no. So you get balance. This is your opening balance for that moment. And this is the ending balance. Right? That's the way you think about it. Right? Last year's ending balance is this year's opening balance. So this is the beginning to the end. That's the way you think about it. We only have revenues and expenses in the current year, right, guys? Well, we only have your beginning balance sheet, and then you're going to have new revenues and expenses for just the current year. And then you do both your income. No, beginning retained whatever all the net incomes have been over the life of the company, less all the losses over the life of the company, all the dividends of the life of the company, give it a beginning retained, right? And then the change retained is add that income, subtract it, right? Or subtract and loss. And I'm thinking when the company's yeah, that'd be the first year. We've got opening balance. Right. The only difference on this is there's opening balance, right? It's exactly what we did on the first quiz. It's just with opening balance. It's not a big deal.
That's a change. That makes it like simple to find. Like, let's say that. See how do you go back and play it?
I know. Like every other beginning price first, and then the ending price, but both prices, right? Yeah. And then start solving. What does this number have to be? You know that one, Matt? I think so. Okay, then solve one. And then you solve numbers. You guys, if assets are set at the beginning and liabilities are 330 at the beginning, what's equity at the beginning? Can you solve that one? Sure. So you're going to write them all down, right? Write everything down you know, and then start solving something. Find something. And then that's going to lead to the next one and the next one, just like we did on that other quiz. We're teaching you a little analytical decision making here, and it's really valuable. Okay, retained earnings at the end. You guys keep working, I'll write these down for me. You can tell me if I put it in the wrong place.
So you have to find out beginning years.
Wait, do they contribute capital?
The owner's investment in the current year, was there one? The owner's investment in the current year is owner's investment, contributed capital to the balance in. So owner's investment.
Where does owner investment go? With contributed capital?
Gets added to it. Does that make sense?
Yes.
Yeah.
Then, when we're doing one for 2011, they don't have the owner investment, or they do?
We don't care because that can only happen for the current year. It's like same with dividends, it could only happen for the current year.
Did they?
Just like revenues and expenses. Does that make sense?
Well, okay, so, but then, to figure the contributed capital for 2011.
You have to back it out, aren't you? It's already in there. Take it out. Right? If it's already in there, you gotta take it out. Okay, that's 330. Owner investment came into contributed capital. There's the investment for the current year. Assets at the end.
Because you have to have the beginning before you.
Whoops, did it in the wrong place, didn't it? Come on, Keith. Dangerous character.
So it's.
Is that everything you knew? It is, isn't it? Is that where you guys started? Okay, I've got beginning assets of 700. I have ending assets of 600. I have beginning liabilities of 330. I don't know the ending. I don't know the beginning equity. I don't know the ending equity. I know revenues is 400. I don't know expenses. I don't know net income. I don't know the beginning contributed capital, but I know I added 50. That's the investment, right? And the ending is 100. Okay. Retained earnings. I do not know the beginning, but I know I had a dividend of 10, and I know I have an ending of 150. I just wrote it down. Is that what you did too? Is there anything I can solve? You know, if you look at this, can I solve liabilities or equity at the end if I only know the beginning? No, there's two unknowns. Can I solve expense or net income? No, there's two unknowns. Can I solve contributed capital beginning? Yes. Because I started with some number, added 50 to it, right? Started with some number here, I added 50 to it, and I got 100. What's the beginning? 50. There is no beginning, I just calculated it. 50. Ah. You have 100 at the end and you added 50 during the year. What do you start with? 50. That's it. Okay, on retained earnings, can I solve that one? No, because I don't know the beginning and I don't know net income. Isn't net income going to come in here? Or net loss come out on the other side, one or the other? Right, guys? So what else can I do? I don't know. No, maybe no. There's some beginning retained earnings probably. Yeah, you can't do it yet. There's two unknowns. So what else can I solve? There's one other thing I can solve. Beginning, yeah. What's 700 less 330? 370. Now I know the ending is 370, do I? Oh, the beginning's 370. I'm lying. Okay. Can I do anything else now? I got that number. How about the ending equity? Could I do that? Oh, yeah. What's 150 plus 100, rather? What's 100 plus 150? Contributed capital is 100. Retained earnings is 150. What's the total? 250. Boy, they had an awful year, didn't they? Equity went way down. Okay, right? 370 to 250. All right, so what's the liability? 600 less 250 is what? 350. We got that one. Oh, man. All right, so then what must have happened in retained earnings? Can anybody tell me anything about retained earnings beginning? Yeah.
You gotta know your net income.
Yeah.
It'd be 160 minus, or what happens?
What do I know about total equity at the beginning now?
It was
It's 370. I just calculated it. What do I know about contributed capital at the beginning? It's 50. So what was the beginning equity? 320. Oh my. I said this company did really bad. So there's their beginning, there's their ending, and there's their dividend over there. Everybody see it? We don't have net income, do we? What do we have? 320. It ends up at 370 equity, right? You see it there? And they have 50 contributed capital, so what was it at the beginning? 320. So they were a profitable company, but what happened to them? They lost a lot of money this year. It's a net loss. How big is the net loss, you guys? Let's see, 320 less 10 would have made it 310, and now it's 150. So how much did they lose? 160. Their net loss is 160. This is not net income, it's net loss, isn't it? Everybody agree? Which makes it a debit. So this is a credit, this is a debit. Guess what expense is? A huge debit, right? You're right, it's a debit. That's excellent. How big does it have to be? 560. Excellent. We got that one now. Are we good? Everybody's got it.
Okay, where did we get 160?
Okay, I know I started with equity of retained earnings rather of 320. I know I ended up with 150, right? And I know I paid a dividend of 10. The dividend would have taken it down to 310. Am I right? And somehow I got all the way down to 150. What'd they do? They lost, net lost 160. Right? Let me do retained earnings bigger. Retained earnings, sure. Retained earnings is 320 at the beginning,
Where?
150 at the end, right? We got that by saying equity's 370. And we got that by 700 less 330, right? Less the owner's investment of 50 is 320. I gave you the 150, didn't I? Yeah. So somehow it went down by 170, but I know the dividend was 10. So that would have made it 320. So you must have a net loss. If I wrote a little bigger, it might help. Would be 160. You got it? Yes, ma'am.
I guess because it's like both of them come together and I'm not following, is there any way you can show us like not together? Like each like balance separately?
Not yet. You mean the 2 years separate?
Right.
No. You've got to start with the beginning. That's what you could do is, well, this is not good though. You could do this and say these are all the assets and it was 700 and now somehow it went down to 600. You can do that, but it's not going to help you. It's going to make it even more confusing if you put T accounts for every single one of these across. All it is try to say it slower. What the heck? Okay, there. Ooh, that was a little too big, wasn't it? What do we start with here? 600. Okay. What I want to do is I know that there are a bunch of transactions that are debiting and crediting assets, right? During the year. There are lots of transactions that debit assets. When I buy an asset, I debit it. When I sell something to somebody, I debit cash, debit accounts receivables, I'm debiting assets. When I buy inventory, I debit inventory, right? Then there are a whole bunch of transactions that credit assets, right? You know, I credit accounts receivable when somebody pays me, I credit inventory when I sell the goods to somebody. There's all kinds of times. Would you say the same thing about liabilities? Sure. And equity, yeah. And things are moving, right? And the same thing with revenues and expenses. What we're saying is something happened that caused assets to go down by 600, right? I know that. And that caused liabilities to go down after I get the liability amount, or went up rather by 50. So it's kind of bad news, huh? I have 100 less assets and I have 50 or 20 more liabilities. So what happened was my equity went down by 120. Of course, that's why. Okay? What could cause my equity to go down? We could have dividends paid out and we could have losses, right? The other thing we could do is buy back stock from shareholders. Okay? So what we're trying to do is just map what happened there. Okay? So the way I set this up is, the reason I set this up this way is to make sure you see the relationship between the beginning, the ending, and what's going on with the income statement, the dividends. That's the purpose of this, okay? No, you've got to interrelate these to each other. Maybe when we do the other one, it'll work better. Okay, let's try that one. Okay, and we'll do it a little more methodically. Okay. You can't just stick with 1 year and then the other year. The reason is this changes to 2 years. That's what caused the change, right? The net income getting added or the net loss taken out. Does that help at all? No. Okay. All right.
Because there were more knowns about that than there were any of the other elements.
Well, on that one, but I wouldn't have to give you all the same information each time, right?
Right, I'm just trying to figure out how to find out.
If there's two unknowns, don't solve that one, solve the one unknown. It'll always work. Okay. Let's try the other one. By the way, you didn't have to apologize for that question. It's really a good question. It's really tough to answer. Obviously. It's tough for me. Okay, so here we go. Let's try the next one. It's just analyzing the balance sheet and income statement, right? So we're going to have beginning and ending. Maybe it'll be better if we put them right next to each other. All right, so what do we know? Contributed capital at the beginning is how much? 200. And at the ending is 100. And what happened, obviously, is the owners withdrew, right? We bought back their stock. This is unusual, but it happens. Not real unusual. They bought back 100, right? So the owner's investment is a negative 100, right? That's the answer to H. Negative 100, okay? Yeah, I already got it, right? Revenues, 240. Net income, I don't know. Liabilities at the beginning are 270. And at the ending are 300. They went up. Okay. Retained earnings at the beginning is 160. Okay. What can make retained earnings go up? Net income could, right? They must have net income. What could make it go down? Dividends. Okay. Oh, and it said dividends are 0. All right. So can we solve anything else here? Net income must be what? 40. So if net income's 40, what were expenses? 200. Okay, now what can you do? You do equity in both cases, right? What do you got? 200 plus 160 at the beginning is 360. What is it at the ending?
300.
How could you make money and have less equity? You earned 40, but the owners took out 100, right, guys?
Right.
Okay, so that's 60 reduction in equity. That's okay. So what's my total assets? 630 at the beginning? Is that what it was? 270 plus 360 and 600 at the end. That okay? Did that help? 100 plus 200. Ending contributed capital is 100.
Yes.
Ending retained earnings is 200. What's ending equity? 300. It's you know what the problem with this is you just have to let yourself relax, right? When you see it, it's kind of like, oh, geez, that's easy. But you have to not try to solve two unknowns because it'll drive you nuts, huh? If you don't know two things and there's only 3 of them, you're done, right? You got to solve one when there's only 2 unknowns. You want to do the first one again?
Let's do it.
All right, one more
First one
time.
again?
Yeah, we're doing the first one again, okay? And now you'll see it's easy, I think. It's okay. Make sure you are not memorizing how to do a problem, right? Because I'll make it look different. different times. You know what you're doing, you know what you're doing, right? Just relax, figure things out. Okay, what do we know on the first problem? We know ending retained earnings is 150, right guys? We write it down. Okay. We know beginning liabilities are 300. Okay. So we got beginning, ending. Okay. Oh, 330. Good, Keith. That'll work out well. Okay, 330 there. All right. Owner's investment during the period is 50. That made contributed capital more, right? Assets, beginning are 700, ending are 600. Company's getting smaller, it looks like. Revenues, 400. Dividends, 10. That comes out of retained earnings. Look how much you have to know to do this, though. Contributed capital, ending, right, is 100. What can you solve? I can see three things I can solve right now. You know what? Yeah, beginning contributed capital is how much? 50, so we got that one. You can solve for equity, what? At end? 100 plus 150, you can do it at the end. What's that, 250? This is 250. Whoops, 250, I'll put it up here. So. All right, and you can do it at the beginning too. Not down here, but up here you can. 700 less 330 is how much? So like we said, it's 120 reduction in equity. It's ugly, isn't it? Okay. And with the owners putting in another 50, they lost a lot of money, right? Must have lost a lot of money. Okay, so what else do? We do the liabilities up here. How much is that? 350. What else can we do now? Oh, you can do the beginning retained earnings, can't you? What are you going to do? 370 less 50 is 320. The total equity is contributed capital plus retained earnings. 50 plus some number is 370. What is the number? 320, right? So it's 370 less 50. Contributed capital plus retained earnings has got to be your total equity, right, guys? What the owners contributed plus what you earned in cash, right? That's what we're saying. So did that answer it? Yeah. Okay. All right. So now what can we do? We can get net income or net loss. It's got to be obviously a what? Net loss. How much? 320 made it less 10 made it 310, and that went all the way down to 150. How much did they lose? Okay. So now we know it's not net income. What is it? Net loss. It's 160. This is a debit. Debits and credits help. This is a credit. How big does this debit for expense have to be? 560. It's got to be 160 more than the 400. Boom.
So if the retained earnings ending as low as the beginning, then they obviously lost money, right? So it's going to be a net loss.
Well, yeah, but a dividend could be bigger than the income too.
Okay.
So if you earn 10 and you did a dividend of 40, you still count by 30. Okay. So is this working out for everybody? Question? Practice. Yeah. How did I get the 320? I took 370 here, right? Less the 50 here. Because 50 plus some number is 370, right? Contributed capital plus retained earnings is total equity. Did I do it? Good. Man, you guys are slow. No, that's all. I'm slow. These review sessions really pay off. Get it. By the way, when you're doing upper division classes, you won't need a review session. You kind of stop doing it. Nobody comes. Why? You do this yourself. You do this yourself. Right? You take the stuff and you pull it apart and you try to put it back together and pull it apart and try to put it back together. Okay? I learn very little now, ever in the classroom. I learn talking to people who are working the similar things I'm working on, and I learn reading stuff. And then trying to understand. Not everybody talk to you anymore, right? So how's am I gonna pay? Okay, I'm not kidding. So that's the problem. That's how you're gonna progress, you guys. You'll get there. You will. Okay, let's do it. You wanna do the second one? All right, what would be the effect on the year-end December 31st financial statements of failing to record the necessary adjustment for insurance that was used that year? I failed to make an adjustment for insurance. Okay, it says on March 1st, notice it's not 31st, it's March 1st, only 2 months have gone by in the year, right? There's 10 more in the year. They got a year in December 31st, right? It's 10 more months. How much insurance expense are we going to have for the year? 10 months, right? It's $36,000 for 2 years. So what's 10 months? 36,000 is for 2 years, right, guys?
Right.
That's 24 months. So how many months have gone by between March 1st and the year in December 31st? 10. It's 10 24ths of it. Would you guys agree with that? Divide it by 24 and take it times 10. That's going to be my insurance expense when I'm done. That's what I want in insurance expense. Am I right? How much is that? Divide 24 in.
It's 3,600.
Oh, it's not thousands. Thank you. Good man. Hey, see, he's getting so he'll challenge me. I like that. I'm not kidding. I really do like it. I want somebody to go to work for me if I'm running a shop who has the courage to say, hey, we're just going to mention that class, one of the classes today.
1,500.
Big time. Okay, it's 1,500. So we think 1,500 got used up. How much did not get used up, obviously? It's 3,600 times 14 24ths, right? It's the rest. 3,600 less 1,500, that's the easy way to get it. What account is that going to be in? I didn't use it yet. What is it? An asset. They haven't earned the premium yet, the insurance company, but what do we have? An asset named. Yes, prepaid insurance. Insurance I paid in advance is called prepaid insurance. Okay? So now all we got to figure out is how did they record it? When they recorded it, they said they recorded it as a deferral to an asset, in other words. I said asset even. What asset? Prepaid insurance. So what they did when they recorded it back on March 1st is they debited prepaid insurance, didn't they? For how much? No, 3,600. Yeah. And what did they credit? Cash. They bought insurance policy. And they went to an asset account. By the way, could it say they went to an expense account? Sure. What would the expense account have been? Insurance expense. Okay? So be careful. What does it say? Right? Okay, if that's what they did, and it is now December 31st, what do you want to do? What's your balance in prepaid insurance? For this insurance policy, at least. It's 3,600. You guys agree with that? I'm just posting this in there. What's your balance in insurance expense? It's nothing. On this insurance policy, nothing. Right? So now what do we do? What did we just say we want the prepaid to be? 2,100. What did we just say we want the insurance expense to be? 1,500. This is going to work out really good. What's my adjusting journal entry? Here's my entry. What would it be? Debit, insurance expense for 1,500, right? Prepaid insurance. That's the adjusting journal entry. So this is a hard problem because you've got to do this first. You've got to know to do it. Credit, prepaid insurance. Okay, now, answer the question. If I don't do this, will they be overstated, understated, or no effect? If you can get this entry, answering the question is really easy. All I'm doing is this, you guys. Okay, what would a debit to insurance expense do? Increase it, right? 1,500. what would happen to prepaid insurance? It's an asset. What would it do? Decrease 1,500. What would happen to liabilities? Nothing. There's no liability in there. What happens to equity? Must go down. Right? Same as assets. Revenue? Expense went up, what happened to net income? Which is what caused the reduction in equity. Okay, now, but this didn't ask what the effect is, it asked what would be wrong if you don't do it. So one step further, we did these in class, didn't we? One step further. What's wrong if I don't reduce assets? Overstated 1,500. Liabilities? No effect. Equity? Overstated 1,500. Revenue? No effect. Expense? Understated 1,500. Net income? Overstated 1,500. Ta-da! You can do this, can't you? What do you have to do, though? Get the journal entry, the adjustment. That's what you're changing the statement spot. Okay? Now, what if I said instead that they had debited an expense account instead of an asset account? Let's do it that way. What if I said that? We debit an expense account, not an asset account. What would be different, you guys? What do you think would be different? Let's see if I get a little more room here. What would the entry have been in the first place? By the way, you'd still want the balances to be the same, right? I'd still want prepaid to be this one, I'm done, and insurance expense to be that, right? Because that's what it is. But if they went to an asset first, what would that entry have been on March 1st instead? Wouldn't have been debit prepaid. If they went to an expense, what would it be debited to? Insurance, you guys. What expense account would they go to? Insurance expense. Good. Insurance expense. 3,600. That's where you would have gone and credit cash. If it says it went to a nominal or a temporary or an income statement account, insurance expense. So now what do I have in these accounts? I've got prepaid insurance with how much in it? Seeing as I put nothing in it. Nothing relating to this policy, at least. What do I have in insurance expense, you guys? 3,600. We just did that, right? Oh, and now I'm doing my adjusting journal entries at the end of the year. At 12/31, I want the adjusting journal entry, right? Here we go. What do I want to do? What do I want prepaid insurance to be? 2,100. Right? Portion we haven't used yet. What do I want insurance expense to be? 1,500. Isn't that the portion I haven't used yet? Or that I have used? I'm sorry. That's what I have used. Remember that? We do this calculation here. Right? Remember that, guys? Okay, good. That's all we're using. Okay, so give me the journal entry. What do you want to debit the prepaid for? What do you want to credit insurance expense for? So I could easily change that problem, couldn't I? Why would I do that? See if you know what you're doing.
What's different about this one?
The original entry went to expense account instead of to an asset
So it went to
account.
an expense instead of that.
Mm-hmm. You got it. The first one, the one that was on the quiz went to an asset, right?
That's gonna
Said
change what's posted.
What? Yeah, it'll change that answer, sure. Because now this is my adjusting entry, right? So what would be the impact? Absolutely. So go ahead and do that. In fact, just go ahead and do that real quick, guys. Practice one. What would that entry do if you failed to do it? Okay. What does that entry do? And then what's over in the statement? Assets would be increased by 2,100, and liabilities nothing, and has to be increased by 2,100, right? And we'll prove ourselves right over here. Revenues? There's no revenue there. Expenses? They'd be decreased by 2,100, which would do what to net income? Increased by 2,100, which is what caused the increase in equity, huh? Right? Now we're there. So overstated and understated. If you need to increase it by 2,100, it would be understated, no effect. Understated, right guys? No effect. Overstated, and understated, which is what caused that understatement. Okay? Do the next one yourselves. Do number 3. I bet you can do it now. It's the same thing, only you're going to stop at the increase, decrease. You don't have to do overstatement or understatement. Right? It's what the increase means. Figure out what the entry is. Do you guys need more light? This is like being at the eye doctor's office. Is that better or worse? It might be muddled at first, but you have to keep working on it. What we want to know is, what is the adjustment journal? You know the adjustment journal? That's what the account number. What does the entry do? So if you, so you just well, they borrowed money, so what would they have done when they borrowed the money? Oh, wait, so no payable is receivable, no receivable. So I have a note receivable, which is an asset.
Right.
So I would have loaned somebody $10,000.
Yeah, but,
So what would I have done?
I would have,
Yeah, that's no receivable.
but like, I don't know what I would
Credit,
do.
cash, I gave you cash. So I have a note receivable this time. It's gonna work just like a payable, only we're on the other side of the deal, right? They have a payable, I have a receivable, they're gonna have an expense, I'm gonna have this revenue. You will have payable, I'll have interest receivable. What? So compute what the interest is for the period of time.
Well, there's no interest is going through my note.
How much should it be? That's what you're gonna do, is accrue it. What's the interest rate?
9%.
So it's 10,000
Yeah.
times 9% would be a whole year, right?
Oh, yeah.
Well, that's 9% per year. So 9% times 10,000 is what? 900, right? So a whole year's interest would be 900. How much time has gone by though? 6 months, so it's not 900, it's half of 900, it's 6 months, so it's 450 of interest. So, and you haven't accrued it yet. Do they owe you more? Sure, 450. What do you call that when you have interest they owe you? Interest receivable, so record it. Ah, it's an asset, you have more. Yeah, that interest receivable, isn't it?
Is that the adjusted one?
Would that be?
Yeah, that's your adjusting
When you
interest.
just put 450, would you put 10,000?
No, 450. You would have recorded the 10,000 when you loaned them the money.
So the
You would have debited notes
the adjustment-
receivable and credit cash when you gave them the money. This is at the end of the year, right? All you're doing is accruing the interest on the note. That makes sense? Okay? So you're gonna debit interest receivable because they owe you more. You don't call it more note receivable. It's just interest receivable. Doesn't get added to the note. You could write the notes with it. No, you wouldn't, well, you're not, are you gonna get cash? No. I'm not loaning them the interest, no. Why do they owe me more interest?
With a credit note receivable?
No, they have interest expense. What do I have? Why are you not loaning money? I want to earn interest. What do you call things you earn? Revenue, it's interest revenue, sure, it's debit interest, receivable and credit interest revenue. If they paid it to me, it'd be debit cash and credit interest revenue. Why would you loan somebody money? They want to earn interest revenue, right? Right, guys? Okay, here's the deal. You gotta understand the business transaction of the accounting, don't you? Why do accountants run so many businesses, accounting and finance staff? No. It's not smarter, they can read financial statements. And that's kind of it. They know what's going on. You can't account for it unless you know what happened. Ah, you gotta know what happened. That's hard stuff. Just know what happened. Not accounting, but Okay, so what do we want to do, you guys? What's our adjusting entry? We said it's a $10,000 note, right?
Correct.
It's 9% interest. That would be a whole year. But only 6 months have gone by. You guys got that? Everybody have that? So that's $450. They owe me $450 more. I need to make an adjusting journal entry to accrue that. So I have more what? Interest receivable, because they owe me the interest, right? And I earned it. That's why they owe it to me. So I have interest what? Revenue. Haven't we recorded stuff like this before? Yeah. Yes, we have. Oh, but expense is just the other side of the deal. Don't make me do the mirror image. Okay, all right. So that's fine. All right, so what would that do, though? Once you know the entry, that's the hard part, is getting the entry, isn't it? It really is. Can you tell me what the effect of this is? Well, of course. What increases? What would that increase and decrease? Yeah. And
Increase your revenue.
which increases net income. There's no effect on expense, right? That increases equity. And there's no effect on liabilities. And if I ask you, would it be over or under, you can do that too. But key is get that entry, it always is. Okay, understand the transaction, get the entry.
Why? Is revenue because it's coming in? Like, why is the revenue planned?
Okay, it's revenue because I gave them $10,000 of my money, and they are willing to pay me $900 a year for the right to use my money, and then they're gonna pay me back my $10,000. I am renting my money to them. That's what interest is. I earn interest. If I gave you $10,000 and you agreed to pay me 9% interest for 1 year, you'd give me back $10,900, wouldn't you? Why? Because you incurred interest expense of $900, and you also owed me the $10,000. But what would I have earned? The $900. Same one you. And the 9%. Well, if I'm trusting you, probably not anywhere near enough. I don't know. What's your credit like? Or your parents co-sign? Yeah. No, it might be, you know what, the answer to that is it's a real high interest rate if you have good credit. It's pretty low if you have good credit. Right? Anybody got a credit card in here? What's your interest rate? Do you know? I have credit cards that are, I don't know, 4 or 5%. What are yours? You have one of your own, not your parents, one of your own. If your parents is 4 or 5%, they have your credit. Probably yours is probably 18. You know, you guys always pay it, because 18% is really high interest, and 9 would be pretty good for you, probably. Yeah.
I haven't been a card.
Yeah, don't run up credit card debt, you guys. You're gonna have enough school loan debt. Okay, so everybody good with this? Did that answer the question on why it's revenue? You earned it. That's why it's revenue.
Well, aren't you including the full payment of $10,000?
They didn't pay it.
So you're saying.
It's not due yet.
You have to separate the tax.
They didn't pay it. I'll mess with that later, I promise. Okay, but yeah, when they pay us, they'll pay this, they'll pay the note payable, they'll pay the interest payable, and there'll be more interest expense when they pay us. Okay, all right, wonderful. All right, gang, let's do something else. Oh, you guys can answer the other one, okay, number 4. How do you increase your expense? It's an expense. What do you do? Yeah, accumulated depreciation. Credit. Unearned revenue. Credit. Prepaid salaries. Debit. I'll put one of those on the quiz too. Why not? That'll be fine. You've got to have some point. Michelle Company.
Depreciation is an expense, isn't it?
Yes, it is. What you're doing is you bought an asset, equipment, or building, and you're using it up over time. And you're using it up, you generate revenue.
Prepaid salaries is,
Prepaid?
you got to pay them their salary.
Prepaid is I paid them before they did the work. They owe me the work. Asset.
So if it was just a regular salary?
Salary expense is an expense. Salaries payable is salaries I owe them. They did the work for me and I haven't paid them yet, right? The word salary, here we go, that's a pretty good one. In fact, let's switch from salary to rent. Rent works better. What does the word rent mean? Sort of like the word salary means nothing, except that it has to do with salary. What does rent mean? It has to do with rent, right? You know what? There's rent expense. What's that? That's when you rent the property, right? And use up that rental, right? You use it for a period. That's rent expense, isn't it? There's rent revenue. What's that? That's when you rent property to somebody and let them use it for a period of time, and they've already used it, so you earn the rent revenue, right? Sort of like interest expense and interest revenue, opposite sides of the transaction, huh? So, important points, okay? Does anybody believe there's such a thing as rent payable? That's where I have rent expense, but I haven't paid for it yet. Everybody agree? Have you ever heard of prepaid rent? Yeah, that's where I pay for the rent in advance. That's an asset, isn't it? So here I have an expense account, a revenue account, a liability account, right? And an asset account so far. It gets worse. I have rent receivable. What's that? I rented property to somebody and they haven't paid me yet, so I debit rent receivable and credit rent revenue. That's another asset relating to the revenue. Okay? Oh my. Okay, and then we could also have what? Unearned rent revenue. What's that? They paid me in advance, and I have a liability. I haven't earned it yet. I haven't let them use the property yet. So what does rent mean? I don't know. It has something to do with rent. If you write down the word rent for me in a journal entry, what am I going to do? Mark it wrong because I don't know what it is. Oh, but look how powerful this is. By the way, here's an expense account. Here's a revenue account. This liability is an accrual because you'd be debiting rent expense and you would be crediting rent payable. This is a deferral, accrual of expense, right? This would be a deferral of expense. And what the idea is, you debited prepaid and credited cash, you're deferring the expense until you use it, and at that point you debit expense and credit the prepaid. We've been doing these things, right? I know you had swimming, but just think about it and look at this stuff. Listen to this part again, okay? Rent receivable, what's that? That's accrued revenue. How is that an accrual of revenue? You will receive it in the future. You already did what? You already earned the rent revenue by letting them use the property, and they're going to pay you later. Debit rent receivable, credit rent revenue, just like that interest there, right? Debit note receivable, credit, or interest receivable, credit interest revenue. It's the same thing. Once you see that, it could be anything, okay? It could be any type of expense, or I guess in this case, any type of revenue, okay? How about unearned rent revenue? What's happening there? It's a deferral of revenue. How do we do that, guys? I debit cash and credit unearned revenue. I'm deferring the revenue until later when I earn it. And at that point, I'll debit the deferred revenue and credit revenue. In this case, rent revenue. Is that helping a little bit? So the word salary means it's salaries. Yeah, it means something else. Yeah, a whole bunch of different. Okay, fantastic. I don't know why I have a blank page in the middle there, but we'll use that one.
This one is just a bunch of journal entries.
The last one's a lot of entries. Okay. So let's see. All right, these guys completed the following transactions. Their year ends December 31st. Read carefully, right? If it's not December 31st, count months up to whatever year end it is. Of course, it doesn't have to be December 31st. Company can pick any date they want, right? Thanks for coming. Please prepare appropriate entries for each transaction. Okay, first, they purchased the equipment for $35,000. They gave $10,000 down, signed a note for the remainder. Just for that, let's do an entry for that first, huh?
Yeah.
What is it?
35,000.
Debit what? They got equipment. We can do this. These are going to look easy after those other questions we were just doing, but it's really just the same stuff. Debit $35,000. Credit what? How much?
20, or 10,000.
And what's the 25 gonna be?
No payable.
Note payable. Okay, points are building, huh? Then it says the note bears interest at 6% per annum, so what's that gonna be? We are going to have interest expense, but not now. The day you borrow money, do you have interest expense yet? No, as time goes by, you have interest expense, so we don't on that date, do we? So this is January 31st. But I'm gonna have interest expense, but it's gonna be based on what? That note payable, right? Not the 35 on the 25. And what's the interest rate? 6% per annum means per year, okay? 6% per year. And they're gonna make two $12,500 payments plus interest. The interest is gonna be included in the payment, okay? So it's two $12,500 payments. Everybody got it? Plus interest. And the date that we bought this thing was January 31st, which is 11 months before the end of the year. Everybody agree? 11 months. How long are we going to depreciate that piece of equipment for this year? 11 months. How much interest is there going to be on this thing this year? 11 months. Everybody agree? Yeah, so be careful. Be careful with the dates. That wasn't January 1st. Okay, and then it says the equipment has a 6-year useful life. Oh, man. Keith went nuts here. 6-year life. And it's got a 2,000 salvage value. Oh, wow. What does that mean? I'm only going to depreciate 33,000 if it's going to be worth 2,000 at the end. So I think, right? I think I'm going to sell it for that, the salvage or residual value. So I'm going to depreciate 33,000 over 6 years. So how much are you going to depreciate every year? 5,500, right? So we could do that if you want. 33,000 is the cost. 2,000 is the salvage value, what it's going to be worth at the end. So what we're going to do is we're going to depreciate, 35 was the cost, right? 35. 2,000 is the salvage. 33,000 is what we call our depreciable value. Okay, the amount we depreciate. Divide that by how many years did I say? 6 years. What would per year be? 5,500. Okay, per year. But how long has this asset been out there? Be careful. By the end of the year. It's only 11 months. So it'll be 11/12 of that. So we can go ahead and calculate it if you want. When are we going to record that, by the way? At the end of the year, not now. But how much is it going to be? Well, it's 12 into 5,500 and then take that times 11. Some strange number. Yeah, something like that. You could round it. Okay. All right. Wow. How much interest is there going to be? Might as well do that while we're at it. Well, it's going to be 6% on 25,000, but then it's only for half a year, so we got to do that entry first. Oh man, so this one's going to be even worse. So let's wait on that one. Okay, March 1st. Let's do some easy ones.
So
Purchase
are we
supplies.
going back?
Yeah, well, we're going to have to because later on they're going to want us to make adjusting journal entries for those. You're not going to make the journal entry for depreciation until the end of the year. You don't have to accrue interest until the end of the year. There is no interest yet. There's no depreciation yet. No time's gone by. That makes sense? So we'll come back to that. Purchase supplies for 2,000 cash. What do you want to do? Debit supplies inventory, right? Everybody knows this one. Credit cash. Don't panic. Just work as you're doing these things, right? Okay. How about March 31st? Paid the rent for the month of March. It's for this month. I paid it this month. What is it then? Rent what? Expense. And I paid it with cash. You like this one, don't you? These last two are really fun. As in easy. Okay. Provided advertising services for client 130,000. What's that going to be? Service revenue, right, guys? Probably that's April 30th. So let's go for it.
What about B, where it says at the beginning of the year, the company had $500 off supplies on hand?
Oh, yeah, what are we going to do with that? At the end of the year, we're going to have to do something with that. Supplies inventory started with 500, and we just added 2,000 to it?
Keep charts going this whole time?
Only when you need them. Yeah. You could wait till the end. At the end, it's gonna say down here somewhere, it's gonna say, is there any entry related to, office supplies? Or actually, it says how many they have when they count it at the end, and then you're gonna have to use that information, so you'd have to go back anyway and find the 2,000. So you could do it now if you wanted, you could wait until the end. Probably better to wait till the end. Get points as you go, okay? All right. In real life, you probably do it all at once. So, yeah, this is gonna be the entry when we buy it, the debit supplies, inventory, credit, cash, and then when we pay for the rent, debit, rent, expense, credit, cash. Okay, if I provided advertising services of 130,000, I know I have what? Advertising service revenue, right? Are you guys getting to the point where you can skip through straight to that when you read it? They said they earned revenue. I'm gonna record revenue, right? I don't have to even read the rest of it yet. I know that's a credit for 130,000, don't you? Okay, good. 80,000 was on account. What does that mean? Accounts receivable. Good. Skills are building. Knowledge sets building. It's not all instantaneous, you guys. We got a whole semester. It's okay. All right. 50 is cash. Excellent. Okay. You can do these quickly, can't you? And then spend your time working on the hard ones. Down at the bottom. All right. That's April 30th. May 30th. They received 60,000 clients that we did previously did work for on a credit basis on account. What's that? That's including accounts receivable, isn't it? Yeah, so I debit cash? Absolutely. Everybody staying with us? That one's not bad, is it? And I give lots of credit, partial credit for things that are good on. Okay? F, paid insurance of 6,000. The insurance is for 1 year starting July 1st. And I should have said they debited either an asset account or an expense account. Let's assume they went to an asset account. It's a reasonable assumption. Paid insurance is 6,000. Debit prepaid, yes. Prepaid insurance for 6,000 was it? And credit cash for 6,000. Okay, now what that says is the insurance is for 1 year starting July 1st. But what am I going to do with this? That's for 1 year, but how much time is going to go by this year? June 30th, starting July 1st to December 31st, it's going to be 6 months, right? So my expense is going to be how much for this by the end of the year at 12/31? We already know it's 3,000, don't we? I bet I use that later. What do you bet? But I won't make the entry until December 31st, will I? Okay? It's prepaid till I use it up. Everybody got it? Not bad, is it? July 31st, paid the first payment. Now things get a little more difficult. Okay? July 31st, I'm going to pay the first payment here. Okay, what am I paying?
January 31st, no.
Yeah. So July 31st is 6 months later, isn't it? I'm paying 12,500, half of that 25,000. Everybody agree?
Yeah, plus the 6%.
Plus 6% interest, but it's going to be for half a year. So how much interest is that going to be? Yeah, 3%, half a year. Yeah. So what you could do is you could take for July 31st. I'm going to take 25,000 that was owed times 6%, right, guys? Times 1/2 year, 6/12. Yeah, or 3%. Yeah, I don't care how you do it. Okay, you're doing it with a calculator probably anyway, right? So how much is that? 750. So that's going to be interest what? Time went by and expense. We're not accruing it, we're paying it this time. Right? So it's interest expense. You bet. How much cash am I going to give them?
12,000.
I'm going to give them 2,500 or 12,500. But aren't I also paying the interest? How much cash are you going to give them, gang? 13,250. Aren't you going to give them 12,500 plus 750? Yeah. Okay. See why I don't want you memorizing things? You got to figure this out. What's the full amount of this? It's 13,250 I'm sorry, 13,250 is the cash. The interest expense is 750. What's the 12,500? I am paying off what?
Insurance.
No. This is a note.
No.
Note payable. Yeah. Remember that we credited notes payable. So I've got a note payable that started with 25,000, and I just paid how much? 12,500. So how much is now due? 12,500. When I make the accrual at the end of the year, how much is owed? 12,500. What are you going to have interest on? 25,000 or 12,500? If you borrowed money, you pay half of it back. Do they get to collect interest from you on the whole amount, or just the amount you still owe them? Just the amount you still owe them. So just be careful, right? You have to think through it. Okay, good. Well, see what happens. So that was July 31st. October 4th. Received advance payment 40,000 from clients for advertising services that will be delivered over the next 6 months. What do we get? Credit what? No, I don't have a payable to them, and not giving it back. No. They gave me money in advance. I gave them nothing. I promised to. Unearned revenue. Yeah, that's how you think through it. Unearned revenue. It's a liability, isn't it? Okay, good. All right, December 31st, employees have earned 35,000 but have not been paid or recorded. Now we are to adjusting entries, aren't we? At the end of the year, December 31st. So you guys tell me what happens there. This one's not bad. They work for me. I got the benefit of their work, so what do I have?
Unearned
Wage expense. You bet. Wages or salary expense, whatever, or wages and salary expense, whatever you want to call it. You can't just say salaries.
Salary expense.
Oh, it does say salary?
And you put salary expense.
Yeah, you salary expense or wages and salary expense, either one's just fine. Or just salary expense, just wage expense. I'd take any of that. I didn't say what it was, did I? What do you credit? I'm not paying them. What do I credit? I'm accruing it, not accounts payable. Wages payable or salaries payable. Is that what you said? I just heard you wrong. Wages payable, right? If it's salaries expense, you credit wages payable. Huh? Got it? Sorry, it's salaries expense, you credit salaries payable. It's wages expense, you credit wages payable. Okay, everybody good? That's not bad, is it? Counted the supplies, and there's 700 left. Okay, here we go. There's 700 left in the supplies. Let's go back where we were analyzing those supplies. So you started with 500, you bought 2,000. How much do you have? 2,500. What's left at the end? 700. What don't you have? 1,800. What does it, of course, become, seeing as you used it up? Expense. Yeah, supplies expense. You guys are getting it, aren't you? Nothing like getting you to work hard. Man, that works for me. As long as I don't have to do the work. It's good. Okay, 1231. What's the deal, guys? I want to debit. Supplies expense. How much did we say? 1,800. And credit? Supplies inventory. Yes. Fantastic. Right? You can do these things. It's work. Okay, December 31st, completed 25,000 of the work from H above. H was that unearned revenue, right? Gee, I earned 25,000. What do you want to do? I don't owe them the work anymore, so what do I want to do? Yes, debit unearned revenue. How much? Well, 25,000. I guess you still owe them the other 10,000, right? Or I'm sorry, the other 15,000. Right? Everybody agree? You earned 25 of it, and credit what? Service revenue. Yeah, because you earned it. That's K. Mm-hmm. All right, let's do L. Well, maybe we'll do L. Do we need an entry relating to the insurance in F above? If so, what's the entry? That prepaid insurance was $6,000. The balance in prepaid insurance is $6,000. That's for a whole year. Half a year went by between July 1st and December 31st. How much of that prepaid interest is no longer a prepaid? 3. What is it now? Insurance expense. What should the prepaid be? Only 3. You earned half of it, right?
Insurance, prepaid insurance.
Yeah, that's it. We've done a few of these now, haven't we? Everybody stay with us on that? Puzzle looks. You guys are tired. I have prepaid insurance on my books. We put in there 6,000, right? If only you guys only had my class, things would work better. I know you have other things you do. Yeah, wouldn't that be true? Yeah, okay, anyway. Debit prepaid insurance we did, and credit cash, didn't we? So this is 6, this is 0, and what we just said is, look, I used up half of it. This should only be 3 now. And this should be 3. How do I get there? Debit 3, credit 3. Everybody with us now? Right? Probably already were. Just wasted time. Okay, debit insurance expense and credit prepaid insurance. 3,000. Good, isn't it? Okay, and now what do we got? Anything related to the debt above? Okay, here we go. We're going to do the debt, and then we're going to do anything on the equipment. Guess what the debt's going to be? I owe them more interest. What's the entry going to be? Yes, it's going to be debit interest expense. We need to calculate the amount, but I know it's going to be debit interest expense. What's the credit going to be? I haven't paid it. No, I'm not going to add it to the note. Interest payable, good. I'd only add it to the note if the contract's set to do that. So assume that not. Okay, on the depreciation. The last one is depreciation on N. What do you think, you guys? How do you record depreciation? Do we need an entry? Of course you do. You're going to depreciate it, right? What's the entry? Debit what? Depreciation. I'm using up the building. I'm using up the equipment. Depreciation expense. Excellent. And credit what? I don't credit the equipment. What do I credit? Accumulated depreciation. Yes. Excellent. Okay. Hang in there, you guys. We're almost there. Okay, so now all we got to do is find out the dollar amounts for those two, huh? Okay.
We still owe $1,250.
Okay, on the note, we owe $12,500, don't we? We started with 25, see it? We paid 12,500, and there's 12,500 left. We're not going to pay it until next month, right? It's not due until January 31st. So what are we going to have to do? Accrue interest on 12,500 for 5 months, not 6. This was a hard quiz, wasn't it? I really have fun with this.
Because you don't pay it until January 30th.
When was the payment? July 31st, they made the payment, right? They borrowed the money January 1st, January 31st, right? They made a payment July 31st. How many months since the payment? 5. Okay, good. So let's calculate the interest, you guys. What is it? 12,500 times what? 6%. That'd be a year. Yes, 5 months. You guys are getting it. Very good. So how much is that one? No entry computed. That's like when I do multiple choice and I always have the response that you can't solve this, right? The answer's not there. You know why I put that? Because I write these questions myself and sometimes I screw them up. The answer's not there, so, you know. If you ever work one and you can't get it, just, yeah, it's not there. Yeah. You can imagine writing these problems, what happens to you. But the authors are never hard enough. We got to have hardness for Bellman. Okay, we got it? Good deal. And then on the depreciation, I think we already calculated it, didn't we?
Yeah.
Earlier on. Yeah, what did we say it was? Yeah. Okay, let's go over how to calculate this again. We got a couple more minutes, don't we? We don't have any brain cells left, but we got a couple of minutes. The cost was $35,000, right, guys? The salvage value is 2, so the amount you're going to depreciate is 33. That makes sense? And we're going to cover salvage value, residual value a lot when we get to that chapter. But these authors like to throw things in ahead, so do I, to make you struggle things, right? So you can figure this out. So it's 33,000, right? divided by the 6-year life if we're using straight line depreciation. This is for straight line. There are other types, right, of depreciation, and we'll cover those later. So 6 into 33 is 5,500 per year, right? But the trick was it's only 11 months because it was January 31st, just like on the interest, right? Whole bunch of people that really knew what they were doing did 5,500 here. And on the interest, they did 6 months instead of 5. That's fine. Only a few people got these right when they did a quiz. It's all right, big deal. It's almost no problem. Huh? No, I've shown you how to do it now. Why would you miss it? Yeah. I showed them how to do it in class too. It didn't make any difference. Right? Yeah. Okay, so, yeah, but you'll get it as time goes on, guys. You really will. And so, sort of the tip of the iceberg here. So I want to record that, don't I? 5,041.67. So what do I do? Yeah. 5,041.67 was it? 5,000. Whoops. 41.67. Everybody good? What am I going to show on my balance sheet if I asked you that? For equipment.
We have to go back and do it.
Well, yeah, I'm probably going to give you opening balances and then all these journal entries, right? And then do financial statements. I won't do that. That's impossible. If I ask you for financial statements, I'll give you all the accounts, and you just do the financial statements. But I don't know. Sometimes, either on the quiz, test, or final. But here's the deal. It's really easy. It's really easy. If I give you all the accounts, but I'm going to put them in alphabetical order instead of in the order that they'd be in the chart of accounts. So you have to know what's an asset, what's a liability, what's an equity, what's a revenue, what's an expense. And then you just go through and you label what they all are. And then you put them in the right order in the balance sheet income statement. Right? I probably won't do that until sometime later because I don't have very much time on this. But if I do, it'll be a simple one. Right? Not very many accounts. Yeah. If I do, it'll be a simple one. Does that sound reasonable? Anyway, wouldn't you show equipment of 25,000 on your balance sheet? Of course. And then what would you subtract from it? Less what? Accumulated depreciation of how much? $5,041.67, because this is the first year we depreciated it, right? Next year we'll add to it. The year after that, add again. We'll add 5,500 every year to it until we're done depreciating it. Everybody agree? And at the end we'll have 2,000 left. So what's the book value or carrying value of this asset right now?
19,959.33.
Isn't it 58? Yeah. Is that right? You guys know a lot.
Plus for all of us.
Thank you for spending this time, you guys. Hey, let me tell you this. If you weren't here and you don't watch this video, what will happen to you on this quiz? Oh, man. Bob. Work pays off. It just does. It's like you skip work, you don't get paid, you know? And this is actual work. You might still feel it. You're going to get paid for it. Yeah. You get better grades and you make more money when you graduate. That's it. I know. Well, I told you already about this, right?
Yeah.
I'm sadistic, but you must be Keep working. Keep working. All right.
I'll probably call him tomorrow.
You talking to me? Yeah. Okay.
Last time I called you, right up.
No problem.
What time did you say we weren't allowed to call?
After 10.
Oh.
I called him at 9:50.
And I know I'm a guy that
11. It was like 11. I was like, he abuses his
like too.